And what is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Trade Desk. I've had several people ask me about this one over the last probably at least a month or two now. And this is a stock I've owned in the past. If we go back down to my history here, we could see that the last time I was buying this looks like it was in around $54. And then in May, I sold out at $73, which good thing I did that because, so let's see, where did I sell? I sold right here. And well, I could have made a little bit more money, but then after that, it took quite a dive there. So we are down to what, at least a 5 year low. I mean, you go further back than that, and we're looking at, I mean, this stock was at this price in what, even July 2020. So in the last 5 years, the stock has hit this stock price. What, one, two, three? This is the fourth time pretty much that it's gotten down to this price. And with that being said, so it's basically flat over 5 years. Once again, this is what I've been talking a lot about lately. When the company, let's say, greatly improves their numbers, but the stock is the same price it was 5 years ago, that's normally a good sign that the stock is undervalued. Okay, because that means the company has become more efficient or profitable or successful, whatever, while the stock price is staying the same. Okay. Now, if we look at the numbers for the last couple of years, it bottomed out in Q3 of 2022. So about 3 years ago, they lost money, negative $9 million. Then you fast forward 3 years later, last 12 months they've done over $430 million in net income. Okay, free cash flow, fantastic chart. They're obviously, capex is not getting out of control. The operating income is looking strong. And so free cash flow is going in the right direction. Okay, where else can we see? Let's see. Expenses. So you could even say, okay, expenses are let's look at mainly CapEx here. So it looks like CapEx is growing a lot. I wish it would tell me. Um see, so these numbers have gone, what is that? That's almost a 4x. And then you look at, let's say we look at sales over the last couple of years. And so, I mean, it's, let me see, what is their margin done? So I think yeah, that makes sense. Their margin bottomed out in 2022, only 3%, and now it's about 16%. So they're definitely on the right track here. Okay. The cash balance was very good. It was looking pretty strong up until this past quarter, and that's probably not helping the stock out, but it's not bad. It's 600. Well, okay, I guess they have 650 in cash, and then between debt is 300 million, and then capital lease is 375. So it's almost equal. But I mean, one thing I had trouble analyzing the stock with is their numbers, their PE ratio, their EPS, their net income, because there's a bunch of different numbers here. So here's their PE ratio the last couple of years. This says, so I mean, obviously it's come down a lot, right? Which is a great sign. The valuation is as cheap as it's ever been. PE of 50, okay? Then we go over to Yahoo Finance, and this says the trailing PE is actually a 61 and the forward is 38. So the numbers are all mixed up because it depends. It's hard for me to find any consistency here. You look at, okay, this says year ago EPS $1.66. Qualtrim says it's 87 cents, which, what if I put it on annual? Yeah, it still says it's in the 80 cents. So that doesn't make any sense. Then you look at their earnings report. Same thing here. GAAP diluted earnings per share, 52 cents. Non-GAAP diluted earnings per share, $1.18. So there's not a lot of consistent numbers here. It's kind of difficult to just, you know, it's hard to get a good idea when there's all these different numbers. But the best way for me, and then look at this. If I take the stock price now and divide it by what they're going to do this year, I get 24, which is not what Yahoo Finance says the forward PE is. They said it's 38. So there's a lot of different numbers here, but you could look at it a couple different ways. The bottom line is the valuation has come down a ton. Look at this chart, and then we go over here and we look at the fact that their P ratio has gone, the forward P was 126, then went to the 80s. Now we're down to 38, which 38 is still not cheap, but it's a lot cheaper than where it's been. And when you run these other numbers, it could even be cheaper than that. It's kind of hard to tell. So the one thing I really like that they said in this latest earnings report was, look at this. Customer retention remained over 95% during the quarter, and it is at as it has been for the last 11 consecutive years. That's phenomenal. That makes me very bullish on the stock. They talk about some of the deals they have, DirecTV. They talk about them repurchasing shares, $300 million, dollars, and they have 60 million left. But my whole thing, most of the time, my thesis on a investment is, what is the valuation like? What has the stock price done? Where is it at? And what are their earnings and their growth and their sales look like, right? So this one looks good. 18% revenue and 16% revenue growth expected. Then we go to $1.78 of EPS, a little over $2. And you look at, and this is what I like to see. Look at that chart. Look how beautiful that is. Super consistent, super strong. They're averaging, last 5 years they averaged 30% revenue growth. That's phenomenal. So it is slowing down a little bit, but the 18% is still good. I think the stock should be able to trade at 25 times earnings, maybe 30 times earnings. Um, if it got down to like a 15 or something, I think that would be a kind of extreme. Really on the weak side. I would be surprised. I would consider that pretty undervalued, and I don't think that would last. I could see maybe it trading in the 20s, but I would say around, a 22 or something is where it should be. So let's say we take 22 and we multiply it times this year's earnings. We're looking at a stock price of $40. Okay, so kind of where we're at right now. So it kind of makes me think it's fair valued. But this is a growth company, and if next year they do around that number, then we are looking at, let's see, 22 times 2 point. We're looking at, again, right around $46. But that's if it trades at 22 times. This stock could be trading at 30 times. So you kind of got to weigh your options there. I mean, let's say if we take it up to 25 for this year, we're looking at a 40. See, it's not like a great deal right now. It's just the stock has come down a lot and their numbers are good. So it definitely makes me interested. I like seeing all these numbers. Um, then, you know, I don't know. It has me interested. It definitely has me interested. It just has to make sense. Okay. And I don't know. I would say the valuation still does not look cheap to me, but hmm, see, the thing that makes me bullish though, that makes it seem like it is cheap, again, it's hard to get a good idea of the valuation when there's all these different numbers. But what I do like is if I take 43 and divide it by 2, I'm only paying 21 times earnings, right? That's that that's about where it should be. See, so really, if we're talking about, and that's 2 is what they're expected to do next year, and we're paying 21 times earnings, unless we see some expansion in that P ratio and it goes closer to 30 or something. I mean, if it goes to 28 or something, and then it go to 56. I don't know. I'm not seeing it. It's kind of sad to say, but because this stock has come down so much. I mean, the valuation was so stupid though when it was trading at, 100 and whatever it just said, 130, right? So I like it because their numbers are strong, but the valuation has to make sense. It does not make sense here. And it's terrible that the stock is down so much. It's flat for the past 5 years, and it still does not look cheap, really. It really doesn't. Um, I'm trying to think if there's another way to look at this to get a different perspective on it, but 38 times forward earnings, I mean, I'm just not seeing it. I mean, yeah, I mean they have ways to go before that valuation. If they were growing maybe at like 50% or something, it might make sense, but they're not. They're only at 18, 16%. And you look at other companies that grow around those numbers, they might trade at 25, maybe 30. If it's a super strong moat company, it might trade at 35 times or 40 times, but I don't think that's what this one deserves to be. I think this deserves to be under 30 times. So let's look at their price to sales. What is the price to sales been the last couple of years here? Because that's another way we could measure this. Let's see. All right, price to sales. I like to zoom in just a little bit to get a more accurate reading. Again, 2020 it was just insane. Look at that valuation. 46 times sales. That's just crazy. Okay. So we've come down here. I don't even know if it'll get back up to this 22, 23 range. Even that seems like a lot. So right now we're down to a 7.7, right? Is that what this says? Yeah, about a 7.5. Okay. So 7.5 times. And that is after all this bearish news has kicked in. We're looking at seven or yeah, right around 7, 8 times. So let's say let's pick eight. Okay, let's say we take 8 times sales and they're gonna do, let's say we put three. Well, 3 times 8 is 24. So that should put the stock right now at about $24 billion as valuation. And guess what? We're right underneath that. It's not too far off. So as I wish I could buy this, but it's not it's not there. The buying opportunity is not there. It's it would be, I don't know, your chances of this stock of you actually making decent money and it going to, let's say you wanted this stock to go to like $65, right? Let's say $65, maybe even 70. I would put it at like a 20% chance. Like it would have to be, it'd have to go through like what Tesla and Palantir went through, where like they got super lucky and they just had a lot of investors interested and did not pay attention to valuation. Most companies, investors pay val investors pay attention to valuations for most companies out there, unless they're all hyped up like AMC and GameStop or like Tesla and Palantir was. So if Trade Desk falls into that category, then sure, the stock could go up to $70. But as long as it stays, as long as they treat it like any other company, I don't think it's going to go to $70. So I wouldn't want to buy this unless it was at like maybe around a $15 billion market cap. So this would have to fall. Let's see. This would have to fall like over 20%. I'd have to have at least 20, 25% taken off of that for it to actually make sense and look undervalued for the numbers they're doing. Um, I don't see another way to, yeah. Okay, that's it. That's that's all you could do with this. I would not buy this over $35 a share or so. I would need it at about, I'd like to get it at like $30. And if we have a huge crash in the next couple months, it might go down to that valuation. So let me know what you guys think, and I will see you in the next video.